So anyway, so yes, the point I was making this morning, and I actually made it yesterday too, it's a very, very important point. If the, it's a little short term, but if the dollar drops from 102.13 to 101.5, that's a 0.7 out of 101. So it's more than 0.5%. So if the dollar drops 0.5%, you expect a 2-to-1 ratio for the market. So the market should go up 1%, which the Dow's only up 0.4%, and the S&P is up 0.25%. So this is not the reaction you expect with a 0.7% drop in the dollar, or whatever the hell it works out to, 0.6 something. All you're getting is a reaction to the dollar. Why is that? Because if I want to buy a share of, well, not the S&P, but let's say I want to buy a share of IBM, and IBM's at $100 today, and the dollar drops 1%, right? Then I want $101 for a share of IBM. The value of IBM didn't change. Obviously, it did, though, if you take into account that IBM's revenues are dollar dependent as well, and so on and so forth. And maybe now they'll get less euros from their overseas business than they would have. There's a million factors there, but a short-term drop in the dollar, you pretty much get a direct correlation, because nobody's sitting there and worrying about, you know, the difference of the dollar here. It only matters over the course of the entire quarter, not what happens daily. But daily, in theory, IBM's value has not changed, but the value of the dollar has changed and dropped 1%. Therefore, you need 1% more dollars to buy a share of IBM. It's that simple. Okay, and as I said, though, there's usually a 2-to-1 correlation with the indexes, just because of the way the trading works and accumulates. But at least, in the very least, if you get a 1% drop in the dollar, you should get a 1% boost in the market. And also, of course, commodities. You should also see that pop in commodities as well. Because again, their value doesn't change, only the value of the dollar changes against them. Therefore, you need more dollars. It's not complicated. It's one of the most basic things about the market. And the funny thing about it is, though, this is a problem with TA, right? Because TA doesn't take this into account. TA doesn't take into account a very basic fundamental that moves the market. You know, when some power goes up and down or whatever, when any stock goes up and down and you see a spike, if you're not correlating it with the dollar, what's the point? That wouldn't make any sense, would it? So, you know, it's like it's like if you switch from Fahrenheit to centigrade, right? And well, now I gotta know these things. Okay, 32 is 0, right? Okay, so if you say, let's say here's 0 and here's 32, so you go, oh, it was you know, so and this says 0 and this says 32, and it just depends on what day you catch it. So here's 0, and the next day it's 32, because now you're measuring in Fahrenheit, and the next day it's 0 because now you're measuring in centigrade. In reality, the stock hasn't gone anywhere; it's flat, but you just keep changing the way you're measuring it. That's what it is when the dollar fluctuates. You're changing the measurement of the graph. So the graph then is useless because you're not saying it's not priced in constant dollars. So over time, in theory, this kind of smooths its way out, because we could look at the US dollar over time. It's actually not going to look that stable, though, I'll tell you. But like I said, in theory, but if you look at it over time, I mean, here's the dollar over time. That's your measuring stick. It goes, this is freaking 90, and this is freaking 114. And here's 100. So over a not very long period of time, well, it's pretty long, but over an annual period of time, the dollar that you're measuring your stocks in goes up 10%, down 10%, down 10 more percent, down 10% from the baseline. So from the baseline, up 10%, down 10%, from the baseline, down 10% for quite a long time. Of course that matters. How can that not matter? And in fact, if you look at the S&P, right, well, I need a longer term chart. All right, so keep this in mind. From the beginning of 2022 to October of 2022, the dollar went from 96 to 114. Okay, beginning of 2022 to the middle of 2022, from 96 to 114. That is freaking 18 points out of 96. That's basically 20%. So what happened on the S&P? What do you think happened on the S&P? So here's that same period. So from the beginning of 2022 to the fall of 2022, the S&P fell from 4,800 to 3,600, which is 1,200 points. Well, that's 25%. So the S&P fell 1,200 divided by 48, right? So that fell 25%. So the dollar went up 20%. The S&P fell 25%. Interesting, right? It's you do this any period of time you want, that's going to happen. And yet it's completely ignored. So in other words, did the S&P actually weaken over the course of 2022? No, it didn't. The dollar got stronger and the S&P got repriced because it's priced in dollars. So it got priced lower because you received stronger dollars for your stocks. You didn't really lose value. The people don't get that at all. You know how you lose value? You lose value by converting your stocks to dollars, and then or if you're at the bottom, here's where people get really screwed. You convert your stocks to dollars because you're worried about them breaking down, even though in reality you didn't even lose any money. In constant dollar terms, your stocks are fine. But because they drop 20%, people say, oh, that's my cutoff, I'm stopping at 20%. And then what happens? Then the dollars that you converted to at the top when you were down 20%, they drop 15%. Okay? And now when you try to use those dollars to rebuy stocks, the stocks have gone up from 35 to 41, which is 6, which is, 15% or whatever it is. So now the stocks are up 15%. So you didn't lose any money, but you converted to dollars when they were peaking out at 114, which means you got the least amount of dollars for your stock because the dollars were valuable and your stock was technically not at 114. Then you waited to see if the market would turn around. The market does turn around. You start buying, but now you're buying where the stock's up 15%. All right, this is basically very important to understand this because there's a reason that my main strategy is to hold the stocks and hedge and avoid this kind of bullshit. Because people, and I know it's a lot of moving parts, right? But you just have to accept the fact that there's a lot of moving parts, and therefore your best thing to do is not to jump in and out of stuff. Okay, if the company has a problem and the company is not making money, that's one thing. But you don't jump in and out of stuff just because the currency changed, just because the entire market went down with your stock. That's not your stock's fault. Don't blame the stock. It's like when they fire people because the company's not doing well, and I'm like, they're perfectly good people. It's like I go, I used to do a lot of management consulting, and I'd come into these companies, and they'd be in the middle of doing layoffs, and they tell me I come in to fix the companies, and they think, and the management generally, when you come in to fix a company, I would say half the people I go to consult end up saying, well, we need help on deciding who's going to get laid off because that's the only tune they know is lay off people, and certainly nobody in management, certainly not the people who called me in. Although I couldn't even tell you how many times I'm like sitting there on day one being like, well, this guy's the problem actually. This guy with this $20 million salary is really the actual problem. The guy who hired me. If we lay him off, we could keep several hundred workers and make his salary back real fast. But instead, he'd rather lay off the workers to budget his salary. And then, of course, you can't make as much money because you don't have the workers. You can't treat people like they're not productive when they are. Now, obviously, a lot of companies have a lot of useless employees. That's just, an unfortunate thing about corporate structure. Yeah, you go through, you find out who's productive and who's not productive, and do proper metrics on everybody. But you can't go around just laying off divisions or closing stuff until you analyze whether or not that's a good or bad move for the company over the long term. Someone's got to take an honest evaluation of these things and figure out what's really going on. It's like actually, I mean, if you look at a UBS, in fact, I was just looking at something on UBS, and I was looking deep into a few things they've done recently. And yeah, they haven't really closed anything or changed anything. They haven't even really shut down Credit Suisse. Credit Suisse is still a functioning thing. They're not just like saying, oh, you failed, goodbye, and saying now everything's going to be called UBS. No, they're keeping Credit Suisse right now and saying, let's just figure out what's good and bad about the company over the course of the next 6 months, and we'll incorporate it into our business. They're doing it sensibly, not dollar sensibly, but they can afford to because they don't have shareholders breathing down their necks the way U.S. companies do. They just got $100 billion backstop from the Swiss government, so they can afford to take their time and decide what to do. And wisely, they are doing that. But it's the same thing with your portfolio. You can't rush and make decisions, and you certainly shouldn't let go of a stock just because it's down. Why is it down? What's causing it? It's like our bank stocks. We didn't sell any bank stocks. Our banks were fine. We didn't see any reason to panic, and we gave it a couple of days, and the government jumped in and bailed everything out anyway. Boy, one day the government is not going to bail everything out, though. And I'd say that's going to come pretty soon because we're going to be like $35 trillion in debt after all this bank stuff is cleared up. And, so like next year will be $35 trillion in debt. At some point, especially with the real slow GDP growth, which is being caused by the tightening, which is being caused by the debt, so it's not going to stop. We're going to get to a point where we're 200% of our GDP in debt. And well, God bless Japan. I mean, they're 300% in debt and doesn't seem to bother them. But at some point, and as I've said for many years, though, Japan gets away with it because they have an inconsequential currency. You can't be the #1 currency in the world and be 250% of your GDP in debt. Because who's going to bail you out? Where's that money going to come from? It's easy to bail out Japan's $5 trillion economy, not bail out, but it's easy to lend Japan $1 trillion to cover their loss for the year because the world has $100 trillion. So $1 trillion can go to Japan and say, okay, go ahead, go be another 100% of your GDP in debt. But that can't be done in a $100 trillion economy with the U.S. going, let's say we have 40 trillion in debt and we need $5 trillion next year. Can we really take 5% of the world's GDP and put it into U.S. debt? That's crazy. But that's where we're heading. At a certain point, it goes from 5% to 10%. Once the U.S. economy starts being as in debt as Japan, then it's like a black hole that will start sucking up all the money in the world. And the world's in a shit place, right? Because either you pay the $5 trillion it's going to cost for the U.S. to make it one more year in debt and grow their debt, or you don't pay, and the US defaults, and all the world loses $40 trillion. The 40 trillion of debt in the US defaults, and the world economy of $100 trillion loses 40%. That would be arguably worse, right? It's going to be a long time before, even when we're paying 10% a year to keep the US afloat, it's still arguably better than letting them default. But then you say, well, in 4 years, we're paying the 40% anyway. What's the difference? There's some point you hit at which people are going to finally say, this doesn't make any sense. Stop the bleeding. We'll take the hit, let the US collapse, and then we will have to just rebuild after that. We will have to accept the fact that that has to be done. And not just the US, of course, there's lots of countries, but as I said, we are 60% of all global transactions are done in dollars. 60% of the GDP of the planet, 60 trillion a year, is done in dollars. And the US debt is a couple of $1 trillion worth of that money right now. So as it grows and gets to be a larger and larger percentage, it's going to become a bigger and bigger problem, and it's not going to be a victimless crime. It's only a victimless crime because nobody's collecting. Oh, in China, that's right. That's what I was thinking of today. Oh, how am I going to find this? It's very, very important too. China has broken away. Let's go for the Wall Street Journal if we can find it. There's the Wall Street Journal. And let's find China. So we're going to say world, Asia. China's detention, Chinese church, Chinese Christians. No, these are old. What's going on? Damn it. China global debt forgiveness. That's not it. That's close though. It was news. It was, aha, that's the one. Politico. So, what are we saying here? Okay, so there's an IMF World Bank thing, and we're pressing China to provide more debt relief. And China is starting to say no. They're the world's largest creditor, and they are saying no, we are not going to just forgive debts. We are going to foreclose. And that is going to start a cascading disaster. I mean, the US and China know when they lend money to third world countries, there's a good chance they're not going to get it back. It's a loan, but it's not really a loan. It's only a loan so you don't piss off your people. So basically they're saying China will not get repaid unless it moves to forgive some of its debt. That's usually how it works. That you forgive some debt and cut it down so that they can kind of get on an affordable paying plan, because these countries can't possibly, and when I say these countries, us too. That includes America. We cannot afford to pay them back. It's not coming. There's that really great from the Obama era, when we owed half as much money as we do now, from the Obama era, there was a really great cartoon with the Chinese premier telling Obama, like, where's my frickin' money? It was very good. But that's where we are. I mean, China's financing projects in other countries between 2000 and 2017 was $800 billion in the form of loans. And so they've stopped lending money, which puts more pressure on us and other countries to cover. And they're starting to be like, no, we're not forgiving this debt. You can't just default and we say, okay, have a nice day. You're like, no. And that was always their plan, of course, in all these projects and all this Silk Road bullshit that they were doing was really a way to encourage other countries to spend money, Chinese loan back money on projects, big projects, hydroelectric, roads, so on and so forth, in Africa and parts of Asia and so on and so forth. They were building, even in Eastern Europe, they're building all these projects with China to get all this stuff done, infrastructure, which you know how Chinese love infrastructure. And then China's always had the eye on, well, when they can't afford to pay us back, we're going to own their dam, we're going to own their solar stations, we're going to own their geothermal plants, we're going to own their roads. It's in the contract, it's a loan. The U.S. has just never foreclosed on anybody on these terms. But when China lends you this money, there's a loan document that says, if you do not pay us back, we take possession of your assets. Now, the country would never have sold a massive dam or hydroelectric project or solar project or their highways to China. Had China asked, they never would have done it in a million years. But when they lent money to China and said, we're putting up this asset as collateral, so of course we'll pay you back, nudge, nudge, wink, wink. And now, boom, they're not being paid back. And now all those little clauses kick in. This is a whole new ball game, folks. Very, very, very interesting changes in the world. And it's going to take many, many years, decades to play out. But this is a very thing. And and the U.S. is not we have not got any power in this game at all, because we are, in a lot of these cases, we're not even involved in the transactions, because China has gone with different countries than we have traditionally been lending to. And we're in no position to help them ourselves, because we're as bad as anybody. And if China doesn't forgive our debts and demands to be repaid, we're going to have some problems too. So it's going to be very interesting. Let's see what else is going on. How's the market look? Oh, look at this nice recovery. Very good, very good. Still no good on the Nasdaq though. We got to get back over that 13,000 line. Oh, by the way, it's a good thing to mention because we talk about it a lot. So these are the futures. Now, for a very, very, very long time, for a couple of years, frankly, I think since COVID began, the futures have generally been at or below the current price of the stocks. Okay, what's happened in the last 3 months this year, the futures have done what they used to do, which is predict an ever rising market. So in other words, these futures are quarterly. They end at the end of June. And these quarters predict every day they predict where the market, not where it is today. It really technically has nothing to do with today. But they predict where they expect the market to be in June. So you would say, oh, that's generally optimistic, right? So everything's a little bit higher than it is in the real indexes. But that's just based on, that's based on the expectation that the Fed won't tighten and so on and so forth. You see these guys dip, that's going to be a serious thing. If they cross below where the indexes are, that's going to be a serious problem now. But just so you know why these are different, the futures had been in lockstep all during COVID. The futures had basically been in lockstep with the indexes. Why? Because people didn't know what the hell was going to happen, and they just left it alone. Nobody was really betting a lot that the market would go up or down. And neither did we, because we were generally neutral about things, because because of COVID, everything was getting bailed out. And so you wouldn't really expect anything to go down that much or up that much. It was just, we were just going to meander along until things got solved. Now, things are getting a little better, arguably. In fact, today, Biden just signed the thing saying COVID is officially over. It's out. So, we kind of stopped. I'm in Florida. I mean, the COVID was over 2 years ago for us. But apparently other people hadn't gotten the message or whatever, and they signed an official thing saying it's over. and it's not over at all. That's a good point too. Let's talk about that. And again, I'm, you know, I think some people might consider me like an alarmist about COVID, but that's because back when nobody cared, I said this is going to be a big deal, you know. But in fact, when I went to Thailand, Christmas of New Year's 2019, right when COVID, before COVID became anything, and it had just getting started in China. I had already been booked to go to Thailand for Christmas and New Year's of that year, not for fun. I was doing a project. And I originally had booked my flight. Fortunately, it was first class. I had originally booked my flight through Hong Kong, and my plan was to stop in Hong Kong for a few days and hang out. You know, I wanted to break. It's a long freaking flight, 17 hours of total travel. So I was like, okay, I'll go to Hong Kong first, hang out there for a bit, and then go to Thailand because I like Hong Kong. I had people to see and so on and so forth. It was a good idea. But then COVID came, and so I'm like, forget this, I'm changing my flight. So I flipped my flight to go through Qatar, going the other way around the world, so I wouldn't be going through where this COVID thing was starting to happen in China. So I remember very vividly, it was like, you know, it was starting out, I was reading the papers every day going, that's why I was paying closer attention to it than maybe I would have. But, you know, bottom line is, you know me, I pay attention to a lot of stuff anyway. But that's what that, you know, so I was very, very closely monitoring the situation. And I was telling everyone here, I'm like, this is a very big deal. It was a big enough deal where I changed my flight and changed all my plans because I was not going to fly through frickin' Hong Kong in December of, I guess it was 2018 at the time. Was it 2019? When did it really start? Was it maybe it's 2019? Funny, I should remember what New Year's it was. I'm closing my eyes trying to remember if we had 2020s. I don't know. Whatever. Okay, let's work backwards. So last year was 22, end of COVID. The year before was 21, bad COVID, 2020. So it started in 2020, right? We had 2 years of a real shutdown, and then last year we kind of gave up on the whole thing. And again, like I said, I'm in Florida, so we never cared anyway. I cared. I was very careful actually, but the amount of people here who paid no attention to it is astounding. You know, I mean, I'll tell you, during COVID, I avoided contact with people for the most part. I ordered Instacart a lot to get groceries. You know, I didn't go out much, but my mom and I every week on Sunday would go out somewhere and we would sit outside, an outside restaurant, and we would have a meal. And even at the height of COVID, we always had a meal because it was just drive you crazy just to sit inside and do nothing and never go out and whatever. So even my mom, she's in good health. We had our shots. You know, we wore masks until we sat down at the table. We went to places where the waiters had masks and gloves, but you know, we never got to the point where we weren't even going to do that. But as you guys know from all the stuff I was writing at the time, I was like always doing my math in my head and saying, oh my God, you know, when you go out just to go across the street, because I would go across the street to go get like my sushi burritos or whatever. And I was like, oh, so I'm going out, I go through the door of the building. The building's got, you know, there's 500 people in the building, and then they touch the door and they touch the handle and the knob and so on and so forth. And I'm like, so I'm touching this surface that 100-something people touch, and then I'm touching that door that 100 people touch, and this one. So it's like I've been in contact with like 300 people just to go across the street. It's crazy. So I was always doing the math and trying to figure out, and then I was looking at the infection rates. But anyway, so where were we? Oh yeah, the New York Times. So I was very conscious of all this stuff all the time from the moment it started. And so, like I said, people kind of think I'm a COVID alarmist, but honestly, I was just paying attention. I just considered it to be a problem. So do they still have the COVID data in the New York Times? Oh, yep, there it is. Maybe let's stop doing it. So meanwhile, only 5,000 people a day. And where's our calculator? It's hard to, like, you got to put things in perspective. So every day, 5,396 people. Now this is bad COVID, 5,396. They went to the hospital. It's not because they had a mild cough, times 365. 2 million people are being hospitalized per year with COVID. Okay, they are saying that there are 120,000, 120,530 times 365. They're saying there are only, and get this number, that's why you see these numbers, you really have to do the math. That is 44 million people a year. 15% of our population has COVID, but that's a completely bullshit figure because you all know that at this point, at least half the people who get COVID don't mention it to anybody, because those of us who have been vaccinated, I've been vaccinated 4 times. Those of us who've been vaccinated generally get a pretty mild case, and it's not really worse than a flu, and maybe not even as bad as a flu. And so we don't even go to the doctor or check it out or anything else unless it gets bad. And even then, it's not bad enough to be hospitalized. But this is a huge underreporting. Probably 90 million people, probably 1/3, and 65 million people get the cold, get the flu every year. Probably about 90 million people are getting COVID. Not 120,000 a day, 250,000 a day, but it's no big deal. And I'm not saying it should be a big deal, but you got to understand that the issue here is that people don't report getting it. They're not testing positive because they're not testing. And that's even more so in like the red states where, you know, they pretend it doesn't exist yet. So about 1/3 of the people in this country are still getting COVID and transmitting it. It's not dead at all. It's not gone at all. How can you say it's gone? That's like saying the flu is gone. That's how dumb it is to say COVID is over. It's like saying the flu is over. You know, it'll come back. Don't worry. And then deaths are only. Oh, I'm sorry. Wait. These are weekly cases. Oh, that's better. Okay, good. Let's try that again. So it's weekly cases, not daily cases. Daily admissions, but weekly cases. That's very confusing. So out of the cases that are reported, see, this goes back to my argument though. Out of the cases that are reported, 7 times that, so 35,000, 37,000, whatever, almost 40,000. So about one third of the cases that are reported end up being hospitalization. That's how bad it has to be before people admit before people even say they have a case. But these are weekly. I did not realize that. It used to be daily. So 120,530 times 52 is only 6 million. That's not bad at all. That's 2% of the population. Let's say we double it to 4% or 5%, then only 5% of the people are having COVID. Hopefully that's correct. And then deaths are much better than deaths are so much better than they were. 1,773 times 52. Only 100,000 people a year are dying of COVID. That's fantastic. It's really horrifying, isn't it? Weekly cases about the data, daily hospitalizations. Cases are typically updated weekly or less consistently reported than they were earlier, right? That's true. Test positivity is less. This is basically what I was just saying. There's a serious difference. So, wow. And you see how we have very few real hotspots. That's bad. These guys are bad. Don't go to Montana. And well, don't go to Texas, should go without saying, right? And here's us. See, we have herd immunity here. We've achieved herd immunity. That's good. and California too. So a lot of places that got hit hardest are not bad. Oh, all-time deaths. There you go. Whoosh, Jesus. Look at this. Deaths 659, 214, 800. Wow. State trends. Weekly cases, all time. Oh, all time. There you go. Total deaths, 1.1 million people. So from the 1.1 million people that we had that are already dead from COVID, and the 104 million reported cases of COVID in the US, probably still also half of the actual cases, we are now down significantly. And so Joe Biden's saying it's over. And, you know, it's way better, but it's not over. There's still a lot of it going around. That's the problem. You know, but again, nothing to panic about unless we start seeing it resurge. So we're not going to know. And it's still, the preponderance of evidence still suggests that it came out of from transferred from animals, not from a lab. We'll see what that's going. Inflation, as we noted this morning, is without food and energy, it's still 5.6%. That's this gray line. And with food and energy, it's 5%, but that's because we had a big dip in energy. Oh, that's not going to show it. This is what happened last month. So energy average is around here, like 72.50 for oil. We're starting this month at above 80. That's 10% up to start the month. If we stay above 80 for the month, and now it's 83, if we stay above 80 for the month, then next month is going to say plus 10%. That's not good. And the Fed, who are going to be meeting in May after we see the entire month of April, is going to make their decision. So to say now, today, in the middle of April, that the Fed is going, since the entire reason that the CPI was down was because of energy prices, minus 3.5% last month, minus 3.5%. That wiped out all of the gains of everything else. So if this is minus 3.5% and this is going to be plus 10% from that reading, what's going to happen next month? And the Fed has this data. We'll have it too. But, you know, generally the market ignores any data that isn't published. They ignore it unless it's, you know, obviously energy prices are published, but, you know, it's not published in any sort of way that says this will contribute to inflation. And even though anybody with any common sense can figure this out, you're not going to get this answer. They're not going to take it into account, but the Fed is going to take it into account. They're going to be sitting at their meeting and saying, hey, energy was up 10% for the month of April. They're going to know this on May 3rd. They don't have to wait for the CPI report to see it. And so do you think they're going to pause? But what's happening is a CPI report like this gets everybody complacent about inflation and gets people to start predicting the Fed won't hike, and therefore the futures start rising, or have been rising anyway, but the futures have been rising since this time, right? They've been rising since energy got cheaper in anticipation of the Fed inflation slowing down. The Fed comes off the table. We can go back to our big market party. But, you know, pretty clearly, this is an outlier. This isn't the norm. This is the outlier. What's going to bring this back down? If OPEC is cutting back production, and May is when they're actually going to cut production. So I think coming into May, we could be pretty solid above the 80 line. And if that's the case, then this was everything good today, whatever you call good, it's really not even being taken that well by the market, but everything good today is going to reverse and people are going to be shocked by the CPI report in May. A month from now, everybody's going to go, oh my God, inflation is huge. What happened? I thought the Fed had it under control. And should the Fed not act 2 weeks before and make it their reasoning that inflation is now under control, they would look like idiots. They're not going to do that. They're going to have to raise at least a quarter point next month just to say, and they have to say, until we have consistent evidence that inflation is under control, something like that's got to be in their language so that they can say, we do have our eye on the ball. We do know what's going on. They cannot look like morons at the next meeting. So all this stuff has to get taken into account when we're looking at portfolios and figuring out what we're doing. You know, you got to look, that's your macro picture. Oh, and the banks, of course, still weak. We'll find out with the bank earnings that are coming up. You know, so far, our short-term portfolio is still at $3.9 million. It really has not been hurt much from this entire fiasco that's going on. We got much more aggressively bearish, but we also, fortunately, we took those TZAs off the table. We still have more short calls than we have long calls. No, sorry, we don't. We have we're still we're about even 650 and 800. It's not terribly imbalanced. And on the Dow, it's balanced because we sold these short puts. So we've got this spread, which is net 150. And we sold these short calls for 25 against them, and they're gonna expire worthless in next week, and we'll sell some more short calls. That's how it works, right? And on the TZA, we have more shorts than we do longs because we cashed in. That's really what kept us in good shape, because we cashed in those TZAs. We cashed in half, whatever the price was at the time, but they're 298 now. So we took 298, we threw it to the cash pile. That's why we didn't take a hit here, and that kept us in kind of balance. And we're in pretty good shape. Also, these guys, it's not much, making a little bit of money on those things. We've got the coffee thing is making 10,000 bucks. We've got the TZA is already in there. Coinbase is coming up nicely, making some money, about 30,000 bucks. Even UNG is turning a nice little profit right now. So, you know, that's keeping us in good shape, and that's what we do. That's why we take these bullish offsets in the short-term portfolio. We know we're going to lose money in a bullish market, but we can be smart about it. And we don't have any short puts on the SQQs or TZA. We don't have any short puts. And you know, we don't want to, because we don't know to what extent the government's going to bail things out and the Fed's going to do something. So we don't know to what extent the market will rise. We don't want to be on the hook for getting killed with short puts on indexed ETFs. My tea. All right, so portfolio planning. So anyway, so this is 3.9 basically. Then the long-term portfolio is at 3.7. So what's 3.9? It's 4.6. I'm sorry, 7.6. 7.6 is 100,000 more than our all-time high. So balance. You know, we're better off now than we were a month ago, or more than a month ago, when we hit our all-time high of 7.5. We dipped back very close to 7 when the market was turned down, but now we recovered. How did we recover? We pressed certain positions. That's the watch list. I don't have it up right now, so I'm not gonna bother. All right. Anyway, now last portfolio review. Here's a big thing. We added 23 short puts before the crash. We pulled all of our short puts, whether we liked them or not. We pulled all of our short puts off the table before the crash because we expected something to happen. Not necessarily the bank crisis, but we felt like things were sketchy. So to be safe and to lower our exposure and to lower our margin requirements, we pulled all the hedges. When we crashed and the government, not the day we crashed, but when the government started saying, okay, we're going to guarantee everybody's bank deposits, et cetera, and the Fed started saying, oh, we're going to backstop we're going to buy all these notes back from the banks. Well, that pretty much fixed the whole thing in like 2 days. So we said, oh, well, then it's definitely time to sell some puts. Let's take advantage of this dip. So what did we do? We went through our watch list, which had 60 stocks. We picked 25 of them. These are all from the watch list. We picked 25 stocks, all on 322, basically. And and where was 322, just for reference? March, here's the 20th. So here's 322. So right here, not here. We're not that brave, but a week later on 322. So here's the down day. Here is the 13th, right? So on the 13th, we didn't do anything. And on this day, when it popped all the way back up here, we didn't do anything. And we didn't do anything here. We didn't do anything here. But a week later, the 21st would be a week later, but on the 22nd, we said, oh, you know what? Now we're back over the 200-day moving average. We held it. I think this might be this day. We held the 200-day moving average. We're starting to feel better. And we've had time to look and reflect on whether or not the government backstop is big enough. And we decided, okay, I tell you what, for our first bullish step, because rather than closing our short positions, rather than closing our hedges from the short-term portfolio, let's instead sell 23 short puts in the long-term portfolio. We also added 4 positions as well. So we took on about $400,000 worth of upside potential to offset the $400,000 we expect to lose in the hedges. We expect to lose it. It's insurance. We pay money for insurance. We don't die. We lose the money. We live. You have to have a value to living. But that's the thing, though. If we're gonna have value in living, we need to have some positions that gain value, right? And that's what this is. So we made, here's 2, very rough. So 2 plus 5 is 7, 80, 95, 100, 100, not 100. 10,000, 11,000, 13,000, 17,000, 18, 19,000, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, and 3 is 32, is 40, and let's call that 41, 42. So about $43,000. Well, not counting that. So call it 40,000. So net 40,000. Who's this? Oh, Generac. You got screwed by Generac. So $40,000 net profit, and that's in not even a month. That's in 3 weeks. So we made 40,000 net profit on our hedge, on our short put positions. Plus, I'm sure those longs did good too. I don't know which ones it were. Jeez. Here's one. Here's Pac West. Seeing they're up a few thousand. So let's see. That's net. Now we're at 4,250. Let's say. Who else was 23? I think we bought more of those. I'm not sure. Should be around 222s. Something around 222 would be. I know there were more. Oh, look at that. SunPower. That was an adjustment. I'm not going to count that. That was not a new position. 222 Tesla. Okay, so here's Tesla, which is not doing that great, but it's still another 5. I don't know. There was definitely another couple. I know there were 4 full positions we added. But anyway, so as you can see, 45, 50,000, whatever it works out to, that's a nice offset. That's how we only squeaked out $100,000+ more dollars in this whole debacle of this whole market fall and comeback so far. But that's great. It's an extra $100,000 in our combined portfolio. That's exactly what we wanted to do in an uncertain market. But it's exactly what I'm saying, though. We still want the longs. I don't believe, forget these guys. Oh, BXMT, but that's a put, long put. I think that should have been a short put. I gotta see, I gotta check on that. That probably should have been a short put. What was I gonna say? Okay, so looking at our proper positions, right? I think Moderna is too cheap. I think PacWest is too cheap. I think Plains is too cheap. Apple, I don't see why Apple shouldn't be over 160, and that's we should collect our full position. So in other words, why do I want to take it off the table? This is a 40 times 30 is 120,000, right? It's a $120,000 spread. And obviously, if we're over 150, these expire worthless. These are just short puts. So if we're over 150, and this is a $120,000 spread. So nothing else matters, but we're going to be at 120,000 if we're over 160. I think we'll be over 160. But currently the spread has a value of 167 minus 90 minus 15 minus 9, 53,000. So it's a $120,000 spread. It's at 53,000. So it's going to make like $70,000, which is a nice chunk of change. I'm not worried that Apple's going to be short. In fact, and also, by the way, this is also important when you're doing it. So I don't count Apple as a position that needs to be hedged. It's not big enough where the loss is going to kill us. I know I'm happy to roll it and put more money into it. It's a smallish position for us for Apple, and we don't mind owning it at all for the long term. So therefore, I don't have a big need to hedge this position. So when when I'm looking to hedge and I look at what I have at risk, that wouldn't even fall into my category of what I'm worried about. And so you go through all your positions like that. Do I think Airbnb should be more like 120? Yeah, sure. And even after all this turmoil, it's still at 113. We have 2 years to get to 120. Here's Alibaba. They just rolled out their digital plan and so on and so forth. I think they'll make a comeback, and they already have made a comeback, but do better than that. Big Lots. Oh, that's one we added to on 322. There it is. That's our new. This is a new position in Big Lots, which isn't doing well so far. It's about even. So we did add a new position in Big Lots. Here's Chimera. Oh, that's another one we added to. We doubled our. This was 6,000. We added 6,000 more longs. See if I go through them one at a time. I remember which ones we did. We doubled our longs because it was so low. Our basis is 816. 30 of them get called away at 8. And the rest I'm waiting. I'm not going to cover it right now because I actually believe in this target number here. We got Comcast. We worry about Comcast not. So what's our goal? Our goal is 40. Do we think Comcast will get to 40? Sure. Coinbase. You guys know I love Coinbase. We're actually, yeah, that's a weird one, right? Because look at it. Coinbase is actually like basically on track. That was hurting us for a long time. We rode this sucker all the way down. So Coinbase is like basically back on track, which is what I said. I said, I think they will survive. They will survive. So he wrote it in June of last year. And I said, well, as they were going down, I was like, I think these guys are going to survive the crypto thing. There'll be a fallout from crypto, and a lot of these guys are going to go under, but not Coinbase, because I thought their structure was better than most. And so far, so good. So they're now over our put price. We have the 35.90 spread. Technically, that's 55 times 20 is what, 110,000, right? There's a $110,000 spread. And watch how cool this one is. It's I love this. 80,000. I'll do the 8250 minus 33 minus 78,000. It's a $30,750 credit. This is not a mistake. It's a $30,000 credit on a $110,000 spread. So there's $140,000 of upside, and it's 70 bucks. It's $70,000 in the money. 70,000 in the money above the put price for a $30,000 credit. So if it just stays at 70, you're going to make $100,000. 70,000 in the money, 30,000 credit in your pocket, just $4 grand to go into the position. We're only committing, we're committing to 3,000 shares at 60. That's $180,000 commitment. But you can scale that down to be anything less you want. I mean, it's literally 30. So let's say you take a $10,000 credit and commit to owning 1,000 shares at 60 bucks. So you're really committing to $50,000 net, right? Because you're getting a $10,000 credit. You're committing to owning $60,000 worth of coin. So you'll be net 50,000 into coin. That's your worst case scenario. But if you have 10 of these, and you'd have to do like 8 of these. Let's say you do it like with 7 of these. Let's say you do 7 of these and 10 of these. You would still be 7 times 700 times 35 at 70. So you get 24,000 plus the $10,000 credit, $35,000 of upside. That's at 70. Then another $25,000 if you make it up to 90. How crazy is that? So I mean, again, it's still great for a new trade, but when we took this position, we had a 105, 130 minus 50, so we had like an $80,000 credit when we started. That's insane. But it looked crazy at the time because we sold these puts in December when Coinbase was down here. My reaction to that was, okay, let's sell the shit out of the freaking puts at 60. Even though the stock was at 30, we sold the $60 puts. Why? Fundamentals, valuation. It was worth that to us. Not to mention, though, it's also, and you say, oh, that's so risky. It's not so risky because we sold the $60 puts for 35 bucks. That's net 25. I thought this was stupidly low. We sold puts that made it lower. Net 25 is down here. I said, this is just not happening. We waited and waited and waited until it formed a kind of a bottom. And we looked at the people who were suffering, and I said, this is not the situation for Coinbase. FTX collapsed. That's what caused all this, right? FTX collapsed and everybody started selling everything. I was like, other than the fact that they both trade Bitcoin, they have no similarities whatsoever. Coinbase is a properly regulated financial institution in the US. FTX was a slime ball operation in the Bahamas, operating under no regulations and managed by idiots. So, you know, so that's the basis of the call, the fundamentals, not the chart. But we waited and waited and waited. We waited and waited and waited. And don't forget, we identified it here that we thought this was the correct value back in time. So 60 had always been our valuation line. Nothing changed. The price changed, but the fundamentals didn't change. And so I said there's going to be a shakeout. Other people are going to go bust, not these guys. And by surviving alone, they're going to be a valuable company. But that's what you have to do in a crisis, though, is you have to look for the opportunities. And you can't do that if you've overcommitted. You can't do that if you don't have cash on the side. You can't do that if you don't have hedges. So all this boring stuff we do to lock in the gains in our portfolio and to maintain a position and the quote rallies that we miss out on sometimes are all to set us up, though, to take advantage of the bargains. I don't want to take advantage. Not that I don't want to, but I don't want to. My system there. Believe me, we've tried. We've tried other systems. It's not like we haven't tried doing it the other way. It would be lovely to say when the market's already up 20% and it goes up another 10% that we make a huge amount of money. But that's not the way it works because it's statistically unlikely. It's fundamentally unlikely. And so we play smart and we say, you know what, 20% is probably toppy. We're going to lock in our gains. We're going to hedge the crap out of things. And we're going to make sure that if the market drops 20% and goes back to normal, that we don't get burned. And that's exactly how we do play it. And then when the market does drop 20%, then we start shopping. If the market never drops 20%, we're going to be behind the market. If it never drops, we're always going to not be quite as good as the market because we're hedging. But it's the hedging that makes all the money. It's the hedging is the reason that this portfolio since 2019, right, same time I took that trip. So when we restarted the portfolios in 2019, 642%. Just doing stuff like that. But I mean, obviously, if this thing we go from a $10,000 credit to a $110,000 gain, that's 1,100% right there. They don't all work out. But the ones that work out make up for a lot of the ones that don't. And these are not all or nothing things. Then we had Crocs. Crocs is oh, wow. I didn't even realize it was up that much. so Crocs is up some crazy insane amount because it's at 128. It blew through our target of 120. In fact, we're now in trouble because we sold more than we had. So we're going to have to actually add some longs or do something about that at some point. Well, if we decide though that Crocs is really something, the same way I say something has to make it worth less, something has to make it worth more. Why is Crocs over our goal? Our goal was 120. We thought 120 for a reason. Now we got to go look at it and say, do I really think Crocs is going to go to 140, or am I happy that I have these extra short positions and they're going to be a good hedge? And there's other tricks. I'll tell you. Well, let's talk about it. May as well. So the other thing is though that when 2026 comes out, I'm going to want to take, what I'm going to do is I'm going to take let's say we take a 110, 140 or 150 spread for 2026, right? I'm going to take that, and that's going to then open the door for me to start taking these guys off the table. We're going to start taking the longs off the table because these 75 longs are $70. That's 145. It's at 128. This is bonus money. So if I take this off the table, which is $684,000, and I cover this 120 with, let's say, 150 of the bull call spreads of 2026, that's how I unwind the position while still leaving myself some nice upside potential. And of course, what was the original price we paid for these? We paid $200,000 for these. So if I sell this for $600,000 and I spend $200,000 for a new set of higher bull call spreads to protect my, just to protect the fact, just to protect these short calls in case they take off on me. But once they expire, whatever value is left in my bull call spread, my new spread, will then become more profit, or hopefully profit. But even if it's not profit, I'm taking off, what do we say this is? 140. So there's there's 12 extra dollars in here. So there's 120 extra $1,000 of profit because I'm going to terminate it here instead of waiting for the true value. And the true value of this spread is only 45 bucks. Isn't that right? Wait a minute, 25 and 20. Yeah, 45 bucks. Sorry. So this is actually way more. It's 23 more. So, okay. So there you go, $230,000. So by terminating this now, I'm getting $230,000 more than I would make if I waited for this spread to expire. I'm getting a way large amount of bonus money. So that $230,000 extra dollars, I just put it into the 2026 spread that covers the short calls, and whatever value is left over there is bonus. I was never going to make that money anyway. So anyway, that's, I don't want to be boring, but that's, I mean, we go through every position like that, and you have to think about strategically, you know, wow, this is $20 more than I could possibly make on the spread. How do I get it off the table? Now, at this moment, I very much doubt Crocs has any longer spreads. So we may not do that, or I may take off a few. And again, that depends on whether or not we think Crocs is going to go significantly higher than it is now. Do we have December? Is it 2025? No, there's nothing longer than January. So I don't have a lot of options for doing it, but I clearly know what I wish I could do. And I got to think now, how much risk am I going to take? That depends on what we really think Crocs is capable of over the next 12 months. Or honestly, I only have to worry about between here and like July, September. At some point, the 2026s will come out. So let's see what else we got. Cisco, Dell, Devon, Expedia. You know, I'm just looking at this. Is there anything here I don't want? Oh, look at Barrett Gold. Barrett Gold came back nicely for us. Google. Google, I was just complaining about because they're super. It's so messed up the way they've got this in the NASDAQ because it's under GOOG and GOGL. We talked about that the other day. It's crazy. They're double counting it. Here's Hanes brand is no longer a loss. How'd that happen? Did we roll it? Oh, we rolled it. That's why. That's why it's no longer lost, because we rolled it. We took a huge hit on Hanes. Hewlett Packard. Yeah, you know, and look, Hewlett Packard's over our goal. It's another one, right? It's over our goal. It's only net 66 minus 38 is 30. Call it 25. And this is a, wow. This is a 7 times 60 is what? Is it 42,000? 700 times, yeah, 42,000. So it's a $42,000 spread. It's only net $25,000, and they're above our target. Why would I want to get rid of that? You know, which is obviously the case for all these positions, because that's why they're here in the first place, right? They wouldn't be in this portfolio. We go over it every month. They're all here because we have that faith, because we believe these are all good positions. But every month new information comes in and we look at it and think about it again. But you know what I'm saying is that, you know, there's a lot of positions here that have huge upside potential. It's just not even being close to realized yet. And you can always tell when you see 15% and things like that, 15%, where that one's 42%. Oh, that's a put. You know, when you see those numbers, or when you do the math and you see that it's you know, like, look, this is here's Target, right? Well, that's a bad example. Target is apparently what, you know, actually Target's on track. What is this? what do we have here? We have a 130 call. We have 15,200 shorts, and we have another 15,200 shorts. Oh, 2 different years. These are Jans and these are Jans. So basically, we have a 130 200 spread. That's $210,000. We have short puts that are both under the money. So they're well on track to expiring worthless. And then we just say, well, let's see, we got 151,875 minus 24,300 minus 17,450 minus 10,450 minus 10,725. So it's 88,950. And I'm sorry, what did we say this was? This was 70 times 30 is 210,000. So that minus $210,000, 121,000. So it's got 150% upside if Target can get to 200 in the next couple of years. And then you got to pull back and you got to look at the chart and you got to say, okay, well, why does he, just get an idea of where we're coming from. How realistic is that? Well, Target was 250 before the crisis, or not even before the crisis, before this crisis. Target was 250. So 200 is not completely unrealistic. And then we would, of course, go back and say, well, what fundamentals do we have out of that? So now I got to go back to TGT. And we see they have a P of 19. But that's 19 what? Wait. 78, I know it's lower than that. It's $78 billion market cap. And they are projecting a slow 2023, but by 2024, they expect to get back to 4 billion. So that's more like a, well, what is it? It's going to be 78 divided by 3. Whoops. Cannot divide by 0. I can. 3.8. No, that didn't work at all. 78 divided by 3.8. So it's about 20x earnings. Oh, actually, they're right on. All right. So it's 20 times forward earnings, but they can get back to making a lot more money. The numbers are here. So they used to make $3 billion, $4 billion. And that's because they're in an inflation cycle. Target, like many companies, is wages are going up. They haven't been able to really pass it on to the customer yet, but they will over time. And then things will sort of right themselves. But unfortunately, Target is on the wrong end of that cycle where they're getting hit by price increases. They've got to keep their shelves stocked. Also, nature of the business, right? Target is not Macy's. Macy's doesn't have to put fresh fashion on the table every day. Their inventory doesn't roll over like Target's does. Macy's stuff will sit for a year and then somebody will buy it, because as much as people like fast fashion, that's not what you go to Macy's for. And Target is not about fashion, it's about basics, basic skirts, basic pants, basic this, basic that. So those things sort of like roll over constantly. So when there's a supply disruption, Target has to fill up the shelves. When Macy's has a supply disruption, and my mom used to sell sweaters to Macy's, so believe me, I know this. When Macy's has a supply disruption, they pick up the phone and they call all the vendors on their list. They go to the shows and they see 100, 200, 300 vendors, and they will make a little book of like 50 things they like that they want to stock in the women's department, right? So the women's buyer will have a list of 50 vendors who she saw at these shows, and she'll say, okay, these are my top 50. Now she'll end up buying from 20 of them for their fall collection. But if one of those suppliers can't provide because boats are tied up in Singapore or whatever, because there's supply disruption because of whatever reason it is. She just starts calling the rest of her list and says, who's got stuff for me in the US? This is Macy's. Here's your big chance to get in the store. And those people will scramble and drop and do whatever they can to get stuff in there. People want to get into Target too, but the bulk of the bulk of merchandise that has to go to Target means it's not as easy. You know, when you want to supply Target, you've got to be able to supply 100 times more stuff than you're supplying to Macy's. In fact, look, Target, 106 billion, right? 110 billion dollars. Here's Macy's. 24 billion. So, you know, the big difference between what you need to give to Macy's and what you need to give to Target. And so Macy's can fill their gaps and remain profitable and do well, which you can see here. They're holding up $1 billion. Took a hit here, but they're holding up $1 billion. And also, by the way, though, a lot of companies do write-downs when they have periods like this and everybody's losing money. This is a good time to write down inventory and take things because you get a forward tax break. So because of this, they don't have to pay tax for the next couple of years, which means, by the way, good time to be in. And Macy's is trading at, look at that, 5 times earnings, $5 billion, $1 billion in profit. They're actually probably should be added to our list. But anyway, so just the point being that this is how we go through our list. This is how we figure out what we should add, what we shouldn't add. And that's what happens, by the way, when you start, like, you know, you start thinking about Target. I say, well, I wonder how Macy's is doing. And that happens to me a lot. Like I'm reviewing my portfolios and I say to myself, well, how are their competitors doing? That's a good early warning sign for something, either something being wrong or maybe something being right. How are the competitors doing compared to these guys? Who else in the industry is doing it? Like I said, Macy's and Target, not at all the same thing. Target is almost like it's more compared to a grocery store than to Macy's. And I'm not saying Macy's is all that. I'm just saying, though, you know, Macy's is Macy's and Bloomingdale's. So Macy's is more like, if you ever go, right, you go to Bloomingdale's, there's, you know, there may be 2 people, 3 people working there for each customer who's walking around. Whereas Target is way the opposite direction. So they're not doing the same turnover of goods and not bringing in the same amount of money, but the stuff they do turn over has a much higher profit margin for them. It's a completely different business model like that. And you can't really compare them. You can't expect they're going to have the same outcomes at different economic times. And like I said, it's much easier for Macy's to pivot and restock their shelves with something else than it is for Target. Because realistically, you know, people are coming to Target to buy a certain brand or things that they're used to buying at a certain price. And so they can't change their mind. Macy's can usually buy Canadian Goose jackets, right, which is expensive stuff. They can stock things with, they can have a whole area of Canadian Goose, but then Canadian Goose says, oh, Macy's, we're having trouble supplying you this right now. And maybe our prices have gone up or whatever. And Macy's goes, oh, well, thanks, Canadian Goose. It's been nice knowing you. Here's Northern Duck, and we're gonna go sell Northern Duck now instead. You know, it doesn't matter to them. And the people who go to Macy's aren't generally going to be chasing the Canadian Goose. You know, it's like they're really there to just look through the sections in the departments and find out what's fashionable. But there's not that pressure that they have because they have more of the classic sort of looks for people. Anyway, so, you know, you just have to think about how each business works and what they're good at. Oh, here's our buddies at Yeti, killing us at the moment, killing us. So this is this is the credit. So it's 120, 130 minus 90 is $40,000 credit, a bit less, $38,000 credit. And it is a 35, 50, 15 times 100, $150,000 credit spread. So it's a $30,000 credit on a $130,000 spread. Wait, on a $150,000 spread, sorry. We have 5,000 shares of commitment at $50 is a 250,000 commitment, which is underwater right now. But we could liquidate the whole thing. If we lose faith, it's 13 minus 30. So it's about $20,000 loss. So at the moment, we're looking at a $20,000 loss. And that, again, is something people forget about when you look at these things. They say, oh, my God, what's our commitment here? Our commitment is to buy $250,000 worth of Yeti. Okay, what did we pay for the commitment? We had a $20,000 credit when we started. So we're really $230,000 worth of Yeti, essentially, is what we're committed to. That price would be about $45. So 45, and we're down at here. So we're going to lose. Well, wait, I mean, we know what we're going to lose. We're going to lose if it liquidated at that price. At, let's say this was 40 and we're at 45, it would be 5 times 50 would be $25,000 would be our loss if everything else expired worthless and these guys were at 40. Right now we have a 20 out of $25,000 loss. It would be if we flatlined. That's not a problem, right? There's nothing to fold a position over, but we're going to be looking very, very closely at Yeti's next earnings, and we've never had a situation where our stock of the year, our trade of the year didn't perform. So this is going to get interesting. But we have to decide, what are we going to do? We have these down 27%. These are 12. This is 9. We have 100 of them. What do we want to do? But these are only 20. Oh, the long calls are only 2024. So we at some point have to roll them anyway. So we go to Yeti, and again, we haven't decided whether or not their business is sound yet, but certainly nobody has any faith in them. And then I say the 2024, were they 30s or 1250? And if we want to go to the 30s in 2025, it's going to cost us $3. And to go to the 25s, it's going to be, ooh, a lot, $6. And if we want to go to the 20s, it's going to be, wow, close to $10 to go to the 20s. So let's see if that's worth it. That's a lot of money. So if we want to roll these to the 20s, we'd have a 20-50 spread in 2025, and it would cost us $100,000 to make the roll. But then we would have the 20-50 spread with the stock at 40, so we'd be $200,000 in the money, and we've always had a credit. So we wouldn't actually be, so this would be the first time we spend money. Then we could sell maybe 50 of the short-term calls. And let's say, okay, what could we sell 50 of? We could sell 50 of the January. Ooh, let's say we sold 50 of the 50s. That's only going to get us back. Nah, that's not even worth it. $15,000 isn't even worth doing. 25,000 is hardly worth doing. We sold the 4250s. That's going to be tricky. I think on the whole, I'm almost inclined to just wait and see what happens. All right, but it's a little dangerous because we've given more time for our short calls than we've gotten for ourselves. And that's actually, and it hasn't helped us either because this has decayed very quickly. This has gone down very quickly. So even selling the longer calls hasn't helped yet. But the good news is we didn't spend much for this spread. We only spent yeah, we did it like that. So we didn't spend anything. We had a 144 credit. So we had almost a $20,000 credit net on that. And if we do anything, so let's say we did the roll, would be $80,000 to make up, but we'd be moving into a $200,000 spread. That would be 18 times 100 would be 180,000 in the money. That's actually not so terrible, would it? All right, we'll see. So, end of story here is we'll see. We'll have to see how earnings go and take a look at it. That's all we can really do. Oh, the Fed minutes, thanks. Para, do I still believe in Para? Absolutely, I believe in Para. Do I think it's going to happen this year? Probably not. Going to have to give him more time. We'll see what happens. Let's check out let's check out the Fed minutes. That's right. Thanks, Brendan. All right. FOMC. Oh, that was totally incorrect. Oh, and it figured me out. See, Google is really smart at that crap, isn't it? The minutes. La 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 la. So what's the market doing? He doesn't. Powell doesn't talk after the minutes, does he? Oh, wow. Ooh, ow, ow, ooh. Okay. Apparently not being taken well. What's that sound Homer makes when he falls down the mountain? Ooh, ow, ooh, oh. It's so funny. I mean, think about like the day, like up on the CPI, then down because it turns out not to be that good, then up ahead of the Fed, then oops, that turns out not to be that good. It's people are such, the people we trade with in this market are insane. And again, this is why I advocate trying to do nothing. Stay well balanced. When you're sure there's a good move, then make the move. But there shouldn't be a good move except for like once every a couple of times a quarter, maybe make a good move. Not every day. And this is the problem. People retire, people decide to be full-time traders, but being a full-time trader does not mean that you should be trading all the time. And again, I always say it when people ask me what's the hardest thing you have to teach people to do, and it's to be patient. Right? I'm looking at Yeti, it's down, it's our trade of the year. We'd like to get it going and hope something comes out of it, but the reality is it's not time. There's not enough information. There's not the right positioning. There's not the right anything for us to say we should do something with it. So we're going to wait. And when I say wait, probably another quarter, unless these earnings give us some really good indication of what's happening and we can figure out the timing. We may wait another quarter until the 2026s come out. We're going to roll it, but I would rather roll it to a 2026 spread that covers the current short calls than to just roll it to cover the short calls as they stand right now. So acting now is not necessarily our best option. We're better off waiting. Goes for all this stuff. And if you see a definite thing changing that you are 90% certain of, then you can consider doing it, but don't guess. Guessing is not part of trading. It's kind of like being an AI, right? It's kind of like it's like when you watch Watson on Jeopardy, and please don't tell me you didn't. I don't even want to hear about it. When you watch Watson play Jeopardy, they actually showed you how confident it was. In other words, generally Watson would have 3 different answers. Based on the question, it would have the 3 top theoretical answers for the question, or questions for the answer, as Jeopardy works. But Watson would come up with 3 different things in its memory, and it would show you, and they were displaying it on screen, and they would show its percentage. So in other words, this U.S. president, this U.S. president had his second term cut short, had a second term cut short by a bullet. And so, the computer would say 75%, 78% probability who is Lincoln. Right? And then maybe the next one would be, I don't know if anybody else was sacked. Frankly, I don't know. Kennedy wasn't even I don't think Kennedy even got to be reelected, did he? But so in other words, it maybe would say Kennedy though, because just wasn't sure about things. Say 25% Kennedy, he did get shot. Was it the first term, second term? It might not have the information. So this is what we're doing in the market. How sure are we about the information we've got? We're not going to have complete information, but there's going to be a degree of confidence we have based on the information we have now. And again, when you watch Watson play Jeopardy, if it's not 70+% confident, it doesn't even buzz in. It doesn't attempt to answer the question. Why would you answer a question that you're only 60% sure of? You may as well be flipping a coin. And given the rules of Jeopardy and given the rules of trading, if you're wrong, you lose money. So don't guess. But and it's not don't guess like don't ever guess. Don't guess when you're not confident. If you're 85% confident, then guess. You're never going to get to 100. But you can't just out of boredom take the best of the crap that you see. You can't be 50 to 60% confident today on all these different things and say, oh, well, I got to trade something, so I'll take the one that's 60. That's not how it works. Should never be how it works. So let's see, developments in the banking sector. Yeah, that's going to be important. Before turning to other items, the chair asked the federal supervisors to update on recent developments in the banking sector. He also described actions taken from the Fed and other regulatory, blah, 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 blah. Okay, review the U.S. financial markets. Okay, this is important. What does the Fed think about the financial markets? Particularly, Treasury market liquidity was poor. And implied volatility was high. These are not good things. But the market remained. Oh, and don't forget when it was. It's very important. You gotta be really conscious of when they were saying that. That was March 21st, 22nd. It was after. This is when we started buying. Right? March 22nd was the day that we bought a whole bunch of shit. The market remained functional amid substantial trading activity, higher Treasury market. Financial, oh, that's actually why we did start buying this, because the Fed came out and we were like, oh, it's not so bad. No, they came out, I think they came out the day after. Let's see. Nope, it was March 22nd, yeah. So we were already that was the same day we started pulling the trigger ourselves, saying this wasn't so bad. Conditions tightened considerably. Contracts following banking sector developments, equity prices to U.S. banks underperform the broad market, blah, 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 outlook for inflation, and measure of inflation compensation over shorter periods rose, and compensation retraced a good portion and increased later period, and reacted to developments in the banking sector. Forward inflation compensation measures continue to indicate longer-term inflation expectations remain well anchored. Absolutely. As I keep saying, labor is driving inflation. So they weren't seeing, so, a lot of the CPI print for March is because of this retraction in the market. It really is not a long-term thing. It's a aberration in the trend. It didn't change the fundamentals of what's driving inflation. Regarding the outlook for monetary policy, measure the policy expected to suggest that the Fed funds rate would reach a peak in May of 2023, and the target range would then move lower. However, the medians of the response expectations did not show any declines in the target rate through 2023. So in other words, expectations outside the Fed is that we peak in 2023 and go lower, and the Fed internally is like, well, that's idiotic. Why would we do that? And really, why would you do that? If you're at the next meeting in May, the next meeting is the May 3rd meeting. That's what they're talking about. The next meeting in May, they're going to raise prices so that they can lower them in the meeting after that. That makes no sense. That would make them look pretty silly in the first place. That's not what their plan is, and people are being really unrealistic about what it's going to take to fight inflation. As I have said from day one, from way into last year, 6%. When the Fed started tightening, I said 6% is the number. And that's where we should be. Basically, we should be around 6%. They've got to go over 5% for sure. And then hopefully inflation will start to actually come down in a trending way. Manager turn, next discussion of operations and markets, Fed volumes, so who cares about that? Economic situation. The information available at the time indicated labor market conditions remain tight and robust as measured by a 12-month thing. Financial market data showed reactions to the developing sector. There was essentially no economic data. There was essentially no economic data that covered the period. Non-farm payroll increased faster monthly pace, faster than the fourth quarter. March, again, aberration. We were going up. We had a banking crisis. We went down. That has nothing to do with reality. Unemployment rate is still at the same place. Aggregate measures of both participation, little change, blah, blah, blah. Recent indicators of nominal wage growth had slowed and continue to be elevated. Consumer price inflation remained elevated. This is not a good report at all. No wonder the market's down. How are we doing? Oh, that's bad. Real GDP growth seemed to be expanding at a modest pace. Gains in consumer spending picked up. Manufacturing expanded moderately, blah, blah, blah. Nominal trade. Okay, so let's do something here. Let's just, oof, it's too long. I don't think I'm gonna get away with all this, but we'll see. Come on. Okay, now I want to get this in, so I got to go lower. I mean, okay. Control C. Cut this down. How we doing? Do you remember who I am? We are looking at the March 22 Fed statement. Oh. Frick. Sorry, I'm typing on angle. Okay. So be faster than me reading the whole thing, hopefully. So Fed held a meeting to discuss developments in banking center, open market relations. Vice Chair reported the U.S. banking system is sound and resilient. However, pullback in bank lending is expected due to recent developments in the banking sector. The Federal Reserve will be reviewing the supervision and regulation of Silicon Valley Bank to strengthen its supervisory and regulatory practices. In terms of financial markets, the early intermediate period saw the interest rates rising and equity prices falling due to firmer than expected data and policy communications. However, the banking sector developments later in the period led to sharp reductions in treasury yields, especially at shorter tenors, with tightening, oh, that's a good word, wow, and tighter financial conditions. Market contacts expected to pull back in bank lending due to recent banking sector developments. The outlook for the information remained anchored as the forward information compensation measures showed longer-term inflation expectations to be well anchored, while shorter-term measures of inflation rose, but retracing market-based measures of policy suggested the Fed funds rate would peak in May and then move lower, while the median respondents' expectations did not show any declines. The Federal Home Loan Banks sought to maintain liquidity to increase demand for advances by member banks, leading to a sharp fall in the Fed funds volumes for a few days late in the period. Money market rates remained stable, and the use of the dollar liquidity swap lines with foreign banks was minimal, indicating the market participants did not face significant difficulties obtaining dollar funding from private sources. The staff review of the economic situation showed the labor market remained tight, which we just said, with the robust gains, historical unemployment, the consumer price inflation as measured was still elevated in January. Real GDP appeared to be expanding at a modest pace in the first quarter, recent indications of wages. All right, this is how you have to work with ChatGPT. Whoops, that's not the Fed. Okay, then we'll do the next part. Be careful not to overload it. Oh, that's big. Oh, it's too big. Son of a bitch. Seriously? God damn. We're never going to get all this at once. So, quote, and Control V, and there. Oh, no, can't do that. Now we're going to see this is how you measure it. Then I'm going to cut it in half. And I'm going to take this and say Control X. I'm going to cut it. So now I'm going to terminate that here. Ooh, it's still a lot. Damn it. Part 2. Woohoo, I think he's got it. What was the market reaction to the communication from the FOMC's playing Jeopardy over the first several meetings? Over the first several weeks of the intervening period, incoming economic data and FOMC communication appeared to refocus market participants' upside risks. The market implied policy passed deeper than nominal treasuries rose, near-term inflation compensation increased, and the broad stock market indexes declined. Financing conditions for businesses, household, and municipalities had tightened during this period and were moderately restricted overall as borrowing costs increased notably with the expected path of policy rate and the treasury yields, as some lenders appeared to tighten non-price borrowing items. Nonetheless, lending volumes were generally solid. Credit quality was strong overall, although it had worsened a bit for some borrowers. Expectations for future credit quality continues to deteriorate in some markets. Part 3. Oh, last part. Oh, good job. Okay, because I said last part, he's now summarizing the whole thing. This is very smart. This is a summary of the Fed's meeting. The committee agreed that inflation was still unacceptably high, and recent data indicated slower than expected progress on disinflation. They noted the revisions to the price data had indicated less disinflation at the end of the year than previously reported. Participants noted that recent developments in the banking sector would likely result in tighter credit conditions for households and businesses and weigh on economic activity, hiring, and inflation, though the extent of these effects was highly uncertain. So in other words, they're going to be looking for how much of an effect it's had on economic activity. We already know from the non-farm payroll report, it had basically no negative outlook, no negative outcome to employment. So hiring, not down. Economic activity, that's the GDP now. We can take a look at that, but I don't think it came down that much. And inflation, we just saw the CPI, it's down, but it sure is not out. And also, as we see, it's probably just a transitory thing caused by last month's dip. Though the extent of these effects is highly uncertain. The committee agreed it was appropriate to the target price range of the funds for 2.5 to 2.4, reducing the Fed's holdings as discussed previously. Okay, so given the above, do you think the Fed is anywhere near ending their tightening cycle? He's going to say it depends on a lot of stuff. Okay, that being said, the Federal Reserve has indicated that it plans to continue gradually raising rates and reducing its balance sheet in order to normalize policy. However, the pace of hikes will depend on how the economy evolves. It's worth noting the Federal Reserve's decisions are data dependent, blah, blah, blah. Therefore, it's important to keep an eye on the data. Now, if I had the time and inclination, we would be going into, I'd be feeding it the data and saying, here, well, here's this report, here's that report, how does that color your opinion, blah, blah, blah. We have a whole conversation about it, basically. That's what I do. But this is not my 6-screen computer. I need my 6-screen computer to do this because I would have a whole bunch of crap open and keep referring back to reports and cutting and pasting and so on and so forth. But you get the idea. So the bottom line is, as I was saying, without having it out, now I didn't have to read the entire report to do it. But basically, as I was saying, the gist of the whole thing is that they have no intention of not tightening further. That's not, there has to be some overwhelming data that points the Fed towards stopping their quarter point increases between here and, probably 6%, 5.5 to 6 is going to be the range. So 6 I would say is definitely the top. I can't imagine 6 not having enough effect to cool the economy, but that's 20% higher than we are now. So, is 10% higher than we are now going to be enough? Hard to say. But there's no data that I've seen so far between the Fed meeting between March 22nd and today, and now we have to wait until 2 weeks, 2 more weeks, 3 more weeks before the next one. But so far, there is certainly not enough data to indicate that a pause would be recommended by the Fed. It's not there. We still have look, the bottom line is 9.5 million unfilled jobs. It was 10.1, now it's 9.5. You want to call that progress? Sure, that's progress. But again, it's 9.5 after we just had a huge crash in the banking industry, and before any layoffs were made at the banks. So we'll see how that works out. And we'll see how earnings look, and we'll see if people are hot. We'll see if the earnings indicate that people are hiring or whether they're going to be cutting back on jobs. Will the losses from the banks be realized? If they're not realized and they're still sitting on the books, they're going to have to say it, and that's going to hurt. And then expectations will be down. It's a whole mess. All right. So there's still a lot that we don't know and a lot of things to come. And that's where we are at the moment. Still want to be cautious. Obviously, I'm not the only one that wants to be cautious. And we'll have to ride this out. That's all. We're going to stay where we are. I am not apologizing for only making $100,000 during a crash, right? Between the last time, before the crash, before the financial crash, we topped out at 7.5. I remember when it was 2 million and I wanted to cash out. I mean, it was just like 2 million was already like, wow. And then we decided that was the point at which we decided to just keep going. Usually at $2 million, we would have cashed out this portfolio. We didn't. We went for 5. We hit 5. We again decided not to cash out. And now we've teased it up to 7.5. So at this point now, though, I guess we're going to go for 10. But I mean, 10 is ridiculous because it's like, if you're at 10, put your money into a hedge fund and we'll manage it for you after that. Because I'm not going to, just keep running these. We're going to start from scratch again and teach people how to do it from scratch. But we'll see how we come out of this little crisis here. We'll decide what's going on. If we come out well, if earnings look good, we're going to go for 10. If earnings do not look good, and I'm not confident, we're going to cash out and take the goddamn $7 million. And we'll start with a fresh $1 million and see how it goes. You don't need to constantly put your money at risk. You send me $10 million. I got a ton of things to invest in for $10 million. I got lots and lots of good investment opportunities for $10 million that have nothing to do with the market. I have this solar deal. Oh my God. Actually, I put it in chat a couple of days ago. I have this solar deal I'm helping these guys put together. Throws off these enormous tax credits thanks to Biden's infrastructure spending. And you get this incredible amount of income tax credits and depreciation, accelerated depreciation, all kinds of stuff. And then going forward, it's a fantastic investment. It's like a 30-year payout that can be probably 300% more than what you put in. Like really incredible. And it's, you know, very solid stuff. You don't have to put all your money to market risky things. It doesn't make any sense. Anyhow, thanks everybody for coming. I appreciate it. And we shall do this again next week, and we'll see where this funhouse ride goes. But bank earnings Friday, that's the biggie. By next week, we're going to have a lot more information. We're going to know what the banks are doing. That's going to be the key to everything for the rest of the quarter, I think. All right. So thanks, guys. Take care. Oh, wait, see if there's a question before I sign off. No questions? Okay, I must have done a good job. All right, take care, guys.